Hi, it's Nash from Alpha Phi. This is part 2 of the review of the MassMutual 10-pay product. Please hit that like, subscribe so you don't miss any videos in the future. So I got a comment from a client on my MassMutual 12-pay first video because we had mentioned that it's a very similar product to the 10-pay, except the 12-pay has essentially 2 more years of premium paying period and flexibility, and a higher guaranteed rate of 3% as opposed to the 2% guaranteed rate on the 10-pay product. This obviously lowers the guaranteed values on the 10-pay versus the 12-pay. And we're going to look at this side by side so we can actually put numbers to these comments on the guaranteed scales. So lower guaranteed rate for the 10-pay as compared to the 12-pay. This makes also the death benefit on the 12-pay higher, and the net cash value IRR on the 10-pay higher. So a lot of factors going on there. But let's take a look at the guarantees. So we were talking about these two products, extremely similar. So 2% guaranteed rate on the 10-pay and 3% on the 12-pay. This makes the dividend values on the 10-pay greater than the dividend values on the 12-pay. Okay, so higher performance on the 10-pay. The other important thing to note on limited pay products, although the limited pay period, that's for the base premium dollars. You can continue to pay into AILR or the PUA riders on these two products after the premium paying period. So that's good to know, and we're going to look at that in a future video. But let's look at the guarantees side by side so we can understand what does this 2 versus 3% actually mean when making a selection. Do I want to go for those higher potential dividend returns, which whole life companies are very well known, at least the big ones, MassMutual, Guardian, Northwestern Mutual, and New York Life, very well known for paying the dividend values for a very long period of time through very turbulent times, wars, pandemics, you name it? Or do I really care more about the guarantees of the products? And then, you might want to make a different decision. Okay, so that's a quick recap. Now let's jump into the meat of this video, which is comparing the guaranteed rates on the 10-pay versus the 12-pay with actual numbers. Here I have the whole life 12-pay, and this is on a 45-year-old male, select preferred non-tobacco health rating. So this is not the highest health rating, but the second from the highest. So looking at the premiums here, we've got the premium breakdown, base policy insurance, $5,000. The rest is going to AILR and renewable term rider to allow for basically $45,000 dump into the cash value, and the RTR is going to raise that death benefit and therefore raise that MEC limit, allowing for such a large amount of money being dumped into the policy for a very high amount of cash coming back to cash value in early and later years because of that compounding. So we're looking at the guaranteed values. So this is the supplemental guaranteed values ledger. All right, so I'm going to highlight year 1, years 10, let's see, 490K, and then years 13, just so we can keep it all kind of on the same screen. So 41,000, 490,000, 613,000. All right, let's put this side by side. And here we have the whole life 10-pay product. So again, this is on a male 45, select preferred, very similar MEC limit, very similar design. Let's grab it here. All right, we have same design, base policy insurance, $5,000. And then the rest going to AILR and renewable term. So this is essentially $50,000 every single year for the premium paying period. So the AILR dump-in and the RTR. There is no LISR attached to either of these two policies on the 12-pay or the 10-pay. The reason is that we we leave it off to maximize the net cash value IRR growth. If you add LISR with these two products for some reason, the performance is far less. But if you mix in the RTR, the performance is much, much greater. You do lose flexibility because we don't have that LISR component on there. So this is a key note that on both these products without LISR, pure Euler dump-in, this annual premium, the base premium plus the Euler plus the RTR is essentially could be considered a bill. You can't bounce those payments up and down. So this is for folks, the 10 pay and the 12 pay, who really are confident they can hit these numbers on a year-over-year basis. Otherwise, you might lose the ability to contribute into Euler or as much into Euler, or have to go back through medical underwriting depending on the circumstances. So as long as you hit those numbers consistently, it's not going to matter, but you got to be really confident you're going to be able to hit those. So year one, a little bit more in cash value. We're going to look at it side by side, 42,944. We looked at 13, so 499, 792. And then we had year 10, 47,914. And we should compare the death benefits over here, but let's put them side by side. So when looking at the cash value in year one, we have 41,751 on the left with the 12 pay, 42,944 with the 10 pay. Okay. When we scroll down to year 10, we have 490,753 in year 10 with the 12 pay, 47,914 with the 10 pay. We can see that the guaranteed values on the 10 pay are starting to lag a little bit more. Then we zoom out to year 13 and the gap starts to widen. So on the 12 pay, 613,000 in cash value and 499. That is the difference there on the guarantees, at least in these years for this policy. So it's really good to be aware of. Those gaps are going to widen as we get further out. We can do a quick sanity check there. So let's look at the 12 pay first. Let's go out to age 80. We have a net cash value of 953,000. On the 10 pay, age 80, it's only 676,000. So a drastic difference. And let's take a look at the death benefit. 797 on the 10 pay, 1.2 million on the 12 pay. So that gap continues to widen. Those guaranteed values are going to be quite a bit different because the 10 pay is only a 2% guarantee gross, and the 12 pay is a 3% gross. Again, they're gross values, so if you actually calculate the year over year, it's going to be a little bit lower because there are fees and insurance expenses that are paid before that crediting rate. So really good to be aware of. It is still growing. You know, you can see that here. It is growing at about, 53 to 38, you know, over almost $20,000 it's going to grow to here. So it's not growing at a slow pace whatsoever, but it depends on whether you want to go for the really high dividend scale growth or really care about those guarantees. Key factor to consider. So thank you for the comment, and I appreciate it. I hope this is helpful, adding clarity and context to that question on the guaranteed scales when reviewing the MassMutual 10 and 12 pay products. I hope this was helpful. Take care for now. Thanks and goodbye. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.